Welcome back. Can you believe we're already wrapping up 2025? It feels like just yesterday we were staring down the barrel of 7% mortgage rates.
I know, right? It's been a wild ride. But hey, we're ending the year on a much better note. Rates have cooled off significantly, hovering right around that 6.2% mark as we head into the holidays.
Exactly. It's not the rock bottom rates of the past, but compared to where we started in January, I'll take it.
Let's look at the actual numbers. Mortgage News Daily clocked the 30-year fixed at 6.24% this week. That is down over 80 basis points from the end of 2024.
Huge drop. And Housing Wire's Mortgage Rate Center, which tracks locked loans, has it slightly higher at 6.37%.
But interestingly, FHA loans are sitting pretty at 6.11%. So if you're shopping around, there are definitely options in the low sixes.
So what actually drove this relief in 2025? It wasn't magic.
Nope, it was the Fed cutting rates and the 10-year Treasury yield finally calming down. Remember when Treasuries were flirting with 5%?
Scary times.
Yeah, well, Joseph Ponibianco over at AnnieMac points out that we're now in the 4.15% range. The market reduced its inflation expectations, and the term premium, basically the extra cash investors want for long-term risk, has dropped too.
There's another hero in this story, according to Housing Wire's analyst Logan Motoshimi, the spread.
Ah, yes, the spread between the 10-year Treasury and the 30-year mortgage.
Exactly. It narrowed significantly this year. Unlike last year, we didn't see those massive gaps, which really helped keep mortgage rates from spiraling, even when the economy got shaky.
Now, what does this mean for actual humans? Lenders like Atlantic Bay Mortgage Group noticed a spike in refinances every time rates dipped this year.
Specifically cash-out refis. People are tapping into that equity.
Emily Gardner, their chief lending officer, mentioned that the lower rates in the second half of the year really kept their purchase business strong too.
I think there's a psychological shift happening too. Gardner made a great point. Folks have finally realized that 3% rates aren't walking through that door anytime soon.
The new normal acceptance phase.
Exactly. Plus, inventory increased in 2025. We're even seeing more traction in non-qualified mortgages, like DSCR loans for investors. The market is adopting.
Another factor keeping rates in check, good old-fashioned competition.
It's brutal out there. Lenders have been slashing margins just to grab market share.
Panibianco called it a short-lived experiment for some, but the big players left standing have the capital to survive. Basically, if you see an aggressively low rate, it might be a lender fighting for their life.
All right, let's pull out the crystal ball. What about 2026? Are we going to see rates plummet?
Don't hold your breath. Experts are predicting a pretty stable first half of the year.
We've got Fed Chair Jerome Powell's term ending in May, and President Trump will be announcing a replacement early in the year.
Because of that transition, the industry isn't expecting wild movements until maybe the second quarter.
The data backs that up. The Mortgage Bankers Association, the MBA, says inflation is still running above the Fed's target.
Yeah, Mike Fratantoni from the MBA noted that while the economy is growing, it's uneven. The core PCE index, the Fed's favorite inflation gauge, rose to 2.9% recently.
Which means the Fed will likely stay on hold in January. Maybe just one more cut next year.
So, the verdict for the next couple of years? Stability. The MBA forecasts rates will stay in a narrow range between 6% and 6.5%. And Fannie Mae is projecting right around 6%. So, if you're waiting for a crash, you might be waiting a while. But hey, stability is better than volatility. Thanks for listening, everyone.